Hello friends, hope you're doing great. Welcome to our channel. Today we'll discuss understanding of common stocks in India. Yeah, what are the common stocks? And as we have discussed in our last sessions also, common stock gives you first thing that is an ownership in the company and the voting right. So once you buy the share in any company, corporation, you get or become owner of that company, that is to the extent or proportion of the part you have purchased. Okay, you also get a voting right. You also get dividend based on the company's life. When I say so, that means if it's a new company and a growth company, so company might not uh, distribute the income, but they invest the income further for the growth of the company. So if a company is a growth company, new company in its life, maybe 5 years, 7 years, they may not go and distribute dividend. But on the other hand, if it's an older company, larger company like Titan, TCS, Reliance, they have already established, right, and they have uh, reached to a point where they can distribute a regular income to their shareholders. So that's where the dividend comes in. But please understand, it is not a guaranteed income. Like in case of preferred stock, when you buy a preferred stock, you get a partial ownership, no voting right, but you get a guaranteed dividend in that. Okay, now the next point comes is common stock gives you a good liquidity if you invest in a good share, or if you invest in a penny stock or any of the small cap which is a fraud maybe, then you might not get a liquidity. But if you invest in good stocks, then you get a better liquidity there. Okay, and you can trade them, buy and sell in the market also via your broker like NSE, via your broker like Zerodha, Grow or ICICI Security. And please understand, for common stock there is definitely a fluctuation in its price and dividend. Dividend is totally based on the income company has generated over the period of time. Now let's take an example of one of the company, Titan. It's a blue chip company. When I say blue chip, it's a large cap company, well established name in that region. Okay, now if you see the ownership pattern here, I start from the bottom. Public companies and retail investor hold 191 million shares, and if I buy one share in this 191 million, that means my ownership is 1 by 191 million. See the smallest fraction. Okay, now this sector is of ownership forms a 21% of the shareholding. Okay, and mutual funds, ETFs, have also invested 154 million shares, bought 154 million shares. Their market value is around 532 billion. So that's the ownership. For every stock you should go and see the ownership. And if you are a new investor, if you just starting your journey, the next slide is very important for you. And this slide is very important for you. What does this tell? That during this period when I was analyzing the ownership of Titan company with the mutual funds, like if you see the first row, SBI mutual fund, ETF Nifty 50 have invested around 0.84% of its total holding into Titan only. That is around 74 lakh shares it's purchased. That is around a cost of 2500 crores. So then you cannot go wrong when such big mutual funds have also invested in. Definitely there are chances, uncertainty is always there, but on a very reasonable pace you should go good in it. Okay, when you investing in such companies. But what is a difference is your growth or your earning would be slightly lesser. Your earning would not become multi-bagger within an year or 2 year. It will take its own time. But yes, then again we see multiple criterias when we invest. Okay, then comes the top institutional holders. Who all are the top institutions? So if you see here, Tamil Nadu Industrial Development, Tata Sons, and estate of Rakesh Jhunjhunwala, 4% holding. That means 36 million shares. That's huge. Around, if I see uh, it's around 12,000 crores only in this. Okay, so Singapore, SBI Fund Management Limited, Tata Chemical Limited, so all the companies have invested in Titan. So it's a good company. Okay, no recommendation, only from a perspective that you, when you analyze a stock, how you should go and see the ownership. Okay, with that we move ahead. uh, Organization of Indian stock market, we talked about primary market function, that's launching of offer for sale and IPOs, and then secondary market trading, where you have NSEs and BSEs in exchange, and via your broker, maybe Zerodha, Grow, ICICI Security, you go and buy stocks. Okay, and then there is a role of a depository. Depository is like a locker account where they keep your securities and all the information. It's kind of book entry they make, and make sure that it is well managed. Okay, ensuring the safety and convenience for the investors. The last one is clearing and settlement. When we buy a security, this clearing and settlement makes sure that as I am buying a security, I should get security transferred to my account, and the money should get transferred to the seller's account. So this clearing and settlement make sure the transaction happen end to end. NSE Clearing is one of the company subsidiary of NSE. Then come type of common stock. I just talked about it. Growth stock is a company which is aiming to grow faster than average and usually do not pay dividend. And the reason is they do reinvest all the income to the company further. Then comes income stock, where the company is large enough, they give regular dividend payment. So if you as an investor is at a point of retirement, or you are in, like me, in your 40s or 45s, and you think, no, now it's a point that I should not run for a growth company, but maybe I need some passive income. So let me see the trend and then invest. So then you go for income stocks, dividend paying companies. There are very good companies. ITC is there, Coal India is there, REC is there. I believe there are NTPC is also there, but no recommendation. Please do see, it's always your money, so make sure that you invest it properly. Okay, blue chip companies, that is large companies, established companies like Titan, I did talk about, TCS, Reliance. Okay, cyclic and defense stock, yeah, very important note here, right? Cyclic company is where they see a rise and fall and make up form a cycle. Metal stock generally have 7 to 8 years of cycle. What does that mean? They see a rise, then they gradually see their fall, and then they again see the rise. So rise to rise is 7 years. So if a company has seen rise in 2001, they may see another rise in 2007-8 period, or 2006 to 8 period. Even automobile is like this. So please make sure when you are investing in such cyclic companies, you have an understanding that, oh, I am entering in, into a time period when company is moving towards down. Oh, no, 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 that might be a mistake. So you have to see where the cycle is for automobile, for cement industry, for metal industry. Okay, because these are the companies, or these are the sectors which are cyclic in nature. HEG, now you take an example of this company. Demand is tied to steel production cycle, and steel production, being a metal, is has a 6 to 8 year of cycle. So you have to be very careful when you invest in such. Okay, I go ahead quickly. I did talk about market capitalization in last session and this session also. So large cap companies, all the companies have a market cap of 20,000 plus crore. Now you see which all are good large cap companies. Reliance Industry is there, TCS is there, HDFC Bank is there, Titan is there. But please make sure, understand that these are the companies who are large conglomerates, and they give you a slower growth. So if you are focusing on a passive income, in a sturdy income base, and you don't want to take a risk on your capital, then people always look for large cap. But if you are someone in your 20s and you have like lot of energy, then, and you do not have much of the expenses lying up or in a pipeline for coming few years, maybe think of small cap, because there the market capitalization of the company is less than 5,000 crores. Ujjivan Small Finance, Triveni Engineering, and other companies. These companies focus on growth. And when they focus on growth, maybe they don't give you dividend. Investing in common stock, what are the benefits of it? One is your capital appreciate. On an average, 12 to 15% your capital appreciate. So if you take an example, if you have 1 million rupees, 10 lakh rupees, and you invest in FD, what you get is 5 to 7% if you go for a longer term FD and if you are a senior citizen. But if you invest that into your mutual funds, you will get some 12 to 15, 12 to 18. I'm just giving a ballpark number, it's subject to specific mutual funds. And if you go for capital appreciation also, there is 15% average, provided you go into a good stock, you don't go for a penny stock or any risky stocks. So there is a capital appreciation, that is an advantage of common stock. You can take example of HDFC, Reliance, and other companies. They are very liquid. If you buy a property today and you want to sell that apartment or land, it's very difficult because the liquidity is less, and it's always a buyer's market. Okay, then comes the inflation hedge. Investing in common stock also gives you in hedged from inflation. There is 6 to 7% inflation. So if your capital is appreciating by 15% and if you have inflation of 7%, you still have 8% surplus. That way your capital is increasing. Okay, now what are the disadvantages? Please understand, market also moves in a cycle, maybe a smaller or a bigger cycle. So there is definitely a volatility risk. There is no guarantee to the return, whether the capital appreciation will happen or not a particular year, whether the dividend you will get or not. So definitely there are risks to it. Okay, that is the reason, if you see bigger fund houses, if you see bigger research analysts, they are focusing more on the mutual funds and index funds rather than a selective one stock. So you also have to plan your approach, that okay, why not consider, instead of considering one stock, why not let me diversify, why not let me increase my horizon. Okay, now what are the stock dividends? When we okay, when we receive yearly, quarterly, or half yearly income from the company in the name of dividend, that's a direct income coming to you, that is return on your investment. Like Infosys paid 24 rupees per share in 2024. That's an income coming from a share that comes into your bank account directly. Then the next topic comes is stock split. That means stock became of 2000 rupees, that is its price quote. Now company think it's less liquid, let's divide it. So company divide that into, maybe HDFC example, it divided that share into 1 is to 2. That means it's split. Now the number of share or the count of share has increased to double, and at the same time it reduces the price of the share in the market. Okay, so more people can buy it and it become more affordable and liquid. Then comes a bonus share, that is a free additional share given from company reserve to existing shareholder. ITC has given 1 is to 2 bonus, rewarded loyal share customers with extra shares. And then impact on investment decisions, right? So understanding these corporate actions aid evaluating return and adjusting investment portfolio. So whenever you hear about any of the above corporate action, you can plan your investments accordingly. Okay, now price quotes, I did talk about that, your traded price, right? And you always look to Money Control, Economic Times, ET Markets to see the price quotes. Okay, now I would like to touch upon this topic, stock margin and leverage. So basically what you're doing is, you don't have a money, but you want to buy extra number of shares. So what you do, first thing is margin trading basics or margin trading, where investor, you and me, borrow the money to buy the stock. That is also called in banking term, a term called purpose lending. That means I am taking a loan to buy the security. That's called purpose lending or margin trading. What happens with this? One is I increase my leverage so I can take or buy more shares. but at the same time there is more risk. And okay, so you have to balance in between. Then comes risk of margin calls. Margin call is when, so take an example, you have 1 lakh rupees in your account, but you took margin from the bank and you said, I want to buy security. Okay, they said, okay, how much you want? Yeah, you said double. So you got 1 lakh yours, 1 lakh from the bank. Now you have 2 lakh rupees to trade in the market. You purchase share of ABC company of 2 lakh rupees. But what happened? It reduced to 80%. That means you made a loss of 20%. But now you see the 20% is not only on your money, 20% is on entire 2 lakh, that is 40,000 rupees. Now the bank has a policy that if your collateral reduced to 40% or 50%, they'll make a margin call. But now again next day your stock further reduced by 30%. So now it is reduced by total 50%, and the collateral value becomes 1 lakh only. Bank is now at a risk that I have given this guy 1 lakh rupees as a loan, and the collateral value of the share is only 1 lakh. So I am at a risk if tomorrow again this falls. So they make a margin call. They ask you, boss, please deposit extra fund because your stock value has dropped, okay, to cover the losses which may come in future. So in that case they make a margin call. Generally margin call has to be fulfilled within 24 hours, otherwise they will sell your shares next day. So you have to be very careful when you go for a margin. Margin is, you don't have a money but you want to buy a share, so you lend the money from other, but when the share price go down, now you are in a problem. Then you have to go to bank, and bank says, no, 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 first fulfill your margin call, otherwise we will sell your security. Okay, now there is one more term in stocks, common stock, that is shorting. You must have heard naked short. You must have heard, I am shorting a stock. What does that mean? That means I do not have a stock, but I am selling it. I am selling it now, I will buy it later. So total three terms in it. One is borrow and sell. That means I do not have a stock, but I borrow from someone and sell it. Borrow from someone is the one managed by or arranged by broker. The other term here is buy back lower. My understanding is that the price of the stock will go down in a day or two, or maybe same day, or maybe by next week. I will buy the cheaper stock. That is buy back lower. And the last one is unlimited. You sold a stock of ABC company for 100 rupees with the mindset that it will go down to 40 and you will earn 60 rupees. You will pay the interest to the lender who lend you the share, and you also will pay all the transaction cost. Then also you save money because profit is 60 rupees, 60%. But what happened? Stock moved other side, because stock market is all about probability of you winning and losing, right? So stock went up and went up to 200, then 500, then 1000. Now you see the scenario, you sold it at 100, which you didn't have. That was a short naked, without having a cover, without having that stock, you sold it. Now your loss is what? All the transaction cost and the borrowing cost plus 1000 minus 100, because you received 100 rupees, right? So 900 rupees is your gross loss plus all the cost, maybe 950 per share. Now, another topic comes in within this is corporate governance, where governance system, basically every company set up the direct and control, uh, because they want to bring more transparency to entire organization. Now, the difference between a board and a management role is, board is a strategic decision maker. They set the vision of the company. Management is the one who execute all those decisions, and they are the operations of the company. So who is a decision maker? That's board. And who is a executor? That's your management. They execute everything. Now, transparency and compliance is very important. Whenever you invest in any company, go to their website, check what they are doing, what is their business, whether they follow all the transparencies, regulatory guidelines, compliances, and ethical conduct. Then only, if you see the promoter has already pledged 100% of their holding, boss, you do you really want to invest there? I would not do that, because when the promoter himself or herself pledged entire equity, then the even the zeal would go away. So I would not do take the risk. Okay. Summary of this discussion: common stock represent ownership with growth potential, capital appreciation, but requires understanding of market dynamics and risk management. Understand the structure, learn the market organization, study the corporate governance, diversify your portfolio, spread across large cap, small cap, and mid caps, balance the risk and return, don't take much leverage or trading on the margins. Regular rebalancing is very important, right? If any of the company is not performing, you can just take a call to go out of that. Stay informed, continuous learning and market research, that I would repeat all every time, so just be just listen to me. So stay informed, continuous learning is very important. Disciplined approach, like long term perspective with risk management. Please understand, everyone would like to, even I would like to become a millionaire overnight, but there is a gradual process. How our parents would have done that, right? Investing in FDs, post offices, and Indra Vikas Patra. At that time, there were no cryptos, no mutual funds, not much, no options. So they had limited options, but still they earned and saved, right? So follow that philosophy to some extent, make a balance of that. And professional guidance, consider expert advice for complex decisions. When you have a small capital, then take, do take learned decisions. But when you have like a retirement corpus coming, or when you have a bigger corpus which you inheriting, then take a guided decision rather than taking a risk. Reduce your risk taking. Okay. With that, I take a pause here. Thanks a lot for joining this session, and please share your feedback. Do subscribe, like, and share.